up, traders? Vladimir Rybakov here, and welcome to the weekly Forex forecast by Pipcy. What a week we've had. It started with non-farm payroll, which surprised many with absolutely phenomenal number, still below 250,000, but a very, very strong number. And then continue to the CPI, which shows that the inflation, I would say, is improving in the US in a better pace than expected. What all does that mean to the dollar? So let's take a look. First of all, fundamental view, then the technical one. So here is the week we've had. It started with the retail sales in the US, which let's not try to make it sweeter. The numbers are bad. Look at the retail sales here and look at the core retail sales. They are on a 0% read versus positive expectation. But take a look on Wednesday, where the postponed non-farm payroll from last Friday was published. 130,000. 130,000. Almost the double than they expected. The expectation was about 66,000. Phenomenal number. And unemployment rate improves from 4.4 to 4.3%. So the job market is pretty strong, or stronger than the analysts expected. What does that mean? Will the Federal Reserve rush to cut or not? Usually, stronger job market delays the rate cuts. However, if we go all the way to Friday, where it actually happened to be the CPI, both the monthly and the annual, look at the read here. The annual is 2.4%. Drop from 2.7 on the last read, while the monthly is 0.2%. So that means that the inflation improves, and that should, of course, help the Federal Reserve to cut the rates faster. It's a big mess, and it's big dilemma for the Federal Reserve. Let's see what it will be like. And this week, we have the meeting minutes in the US. It starts with the job market in Britain on Tuesday, then the CPI read in Canada, and then it goes all the way to the rates, of course, in New Zealand by Tuesday evening. And on Wednesday, we have the FOMC meeting minutes. This is a very, very, very important one to listen and to hear what the Federal Reserve members have to say about the recent job data, the CPI, and maybe give some hint on what's coming with the rate decision. So let's take a look on the charts. What do we have here? During the week, I published on our channel, here you can find it on Instagram, we had this absolutely phenomenal engulfing dark cloud, but moreover, I'm talking about dollar yen here. Moreover, this is I don't know how to say that, super phenomenal Kasimoto trading pattern. Look at that. A sequence of lower highs, lower lows, then fake high flips to make lower lows, and then another high. But that time, this high is bounced directly from these high levels. And not just that, look at this range where the supply is, the real sellers are, and then we have this major candle pattern, which basically means sell, sell, sell. So the question is it over? I don't think so. I believe the dollar yen has more to offer. I think that this rising trend line should be retested at least, and if this managed to break it down, then the next key level is all the way down to these lows, where we have the gap here around the 147.50, 148 zone, down to 145 psychological low. So I believe dollar yen has more to offer to the downside. And on the 4-hour chart, all these bounces we see are more than welcome, but I think these bounces are nothing more than a sell opportunity to see the dollar yen pushing further down to the levels I just mentioned. And let's talk about the euro dollar. A lot of traders are waiting to see what the euro will do. Will that explode to the upside, or will we see a bullish run? So if we take a look here, on the weekly chart, I believe that the euro dollar should create a peak somewhere here, ideally after making the final climb here, maybe to clean these peaks here. That would be simply ideal, maybe even beyond that level, and from there, once this divergence kicks in and completes, I believe the euro is a major sell. So on the shorter run, on the smaller time frames, I still think that this corrective structure as it develops should provide further buy opportunity on the euro dollar. I do not think, at least as for now, that the rally is over. If we manage to break below the daily low, then we can talk about a different structure, but for now, for me, the euro dollar has some significant levels, and every visit there should be providing further buy opportunities from my point of view. And what's up with the indices? So as you can see, this wage pattern that we were experiencing for a long time on a daily chart, and a heavy bearish divergence. While the market was making lazy higher highs, the MACD is showing strong lower highs, which is a sign of a bearish divergence. I believe that the S&P is still under a bearish pressure on the short term, and these key lows we have on the way, this low, and this low here, should be retested. So from my point of view, as long as the last peak holds, I do expect to see the S&P pushing further to the downside, at least on the short term.